You've probably been sold a story about investing for most of your life. Be smart, be fast, be early. And if you've ever felt like everyone else is winning except you, it's not because you're dumb, it's because that story is designed to pull you into mistakes. If you stay with me to the end, you'll walk away with a clean, simple way to think about investing that removes the confusion. No hype. No magic, just the part people don't explain. Here's the first illusion they sell you, that investing is basically a talent contest. That the winners are the ones who spot the next thing first, pick the perfect stock, and escape the system in one move. Sounds exciting, but it's backwards. And the weirdest part is this, that fantasy is exactly why most people lose. Because the biggest investing illusion isn't math, it's identity. Most beginners don't invest like owners, they invest like gamblers and call it strategy. So in the next few minutes, I'm going to show you the boring truth that actually works. And 3 simple systems that protect you from the traps that wipe out most portfolios. Why most people lose, the simple truth about index funds versus ETFs, and dollar cost averaging, the anti-panic system. 1. The biggest investing illusion: winning means picking. Let's be honest about what most people think investing is. They think it's winning, beating other people, beating the market, calling the top, buying the bottom. But the market isn't a video game where the smartest player wins. It's a machine that rewards consistency over time and punishes emotional decisions made under pressure. Here's the hidden rule. In investing, the enemy isn't the market. It's you. Not you as a person. Your pattern. Because most people don't lose because they picked one bad asset. They lose because they repeat the same chain reaction. They buy because the price is rising, it keeps rising, and they feel like they finally get it. So they take more risk, because confidence feels like knowledge. Then the market drops, and fear suddenly feels like truth. They sell just to stop the pain, usually near the bottom. Then they sit on the sidelines waiting for certainty. And when the market climbs again, they buy back higher, and the cycle repeats. That loop is how beginners donate money to the system. The illusion is that markets reward intelligence. They don't, at least not in the way people imagine. Markets mostly punish emotional timing. You don't need to be a genius to win long term. You need a system that doesn't let you sabotage yourself. And that's why boring wins. Boring is discipline. 2. Why most people lose. 4 silent traps. If you really want to understand why most people lose, you'll see it's not one big mistake. It's 4 quiet habits that show up in every generation, just wearing different clothes. Trap 1. Timing addiction. People think good investors predict the future, so they obsess over the perfect entry, the perfect exit, the perfect moment. But that perfect moment is a myth, because the market doesn't send invitations. Timing turns investing into a stress game, and under stress, you stop thinking clearly and start reacting. Trap 2. Story addiction. Humans love stories. This company will change the world. This is the next breakout. Everyone is moving into this. Stories feel like certainty, especially when prices are rising, but stories usually peak right when risk is highest, because hype pulls in late buyers and sets the trap. Trap 3. Fee blindness. Fees are designed to look harmless. 1% sounds small. 0.5% feels like nothing. But fees compound in the opposite direction. Over years, a small fee can quietly eat a shocking amount of your outcome. The market takes risk from you. Fees take money from you, guaranteed. And yes, once you see it, it feels brutal. It's like a jeweler shaving off a tiny piece every day. You barely notice it until you look back. Trap 4. Panic behavior. Most people aren't destroyed by the market. They're destroyed by their reaction to the market. When fear gets loud, they sell fast. When greed gets loud, they buy. They treat emotions like signals. So the main skill is not prediction. It's refusing to panic. That's the golden rule. Because investing isn't about being right every week. It's about protecting yourself long enough for compounding to actually do its job. 3. Index funds versus ETFs. The simple truth. Now let's clear up one of the biggest beginner confusions. This isn't complicated. People just explain it in a way that makes it feel complicated. Here's the simple truth. An index fund is a strategy. An ETF is a container. Index means you're tracking a basket, like a market index. Fund means pooled investing. ETF means the fund trades on an exchange like a stock. So yes, you can have index mutual funds and index ETFs. They can track the same index and own basically the same underlying assets. Beginners get stuck because they assume ETFs are automatically better, not always. For most everyday investors, it comes down to 3 things: how you buy and sell, how easy it is to automate, and the real costs. A. How you buy and sell. Mutual funds usually price once per day. ETFs trade during the day like stocks. That sounds cool. And that's the problem, because trading during the day makes people touch their portfolio too often. And the more you touch it, the more mistakes you make. B. Minimums and automation. Some mutual funds are built for easy recurring investing. Many brokers now also allow recurring ETF buys. This matters because the best portfolio is the one you can fund consistently without needing motivation. Consistency is the real advantage most people never build. C. Fees and tracking quality. What matters isn't the label. What matters is the expense ratio, how well it tracks the index, and how easy it is for you to stay consistent. If you choose a low-fee broad market index in either form, you're already ahead of most people. That's not hype, it's math and behavior. So the simple truth is this: the best product for a beginner is the one that keeps you calm and consistent, not the one that looks advanced. 4. Why index investing works. You shut down the ego game. Index investing feels boring because it removes ego from the equation. You stop trying to prove you're smarter than the market. You stop saying, "I think this stock will win," and you start saying, "I'll own the market itself." That shift is powerful, because markets reward exposure over time, and constant prediction can't compete with time. Index investing isn't designed to make you look smart. It's designed to stop you from repeating the same emotional mistakes that wipe people out every cycle. That's why it's a hidden rule strategy. You don't win by chasing winners, you win by avoiding traps. 5. Dollar cost averaging, the perfect anti-panic system. Now, let's talk about the system that stops your brain from sabotaging you, dollar cost averaging, or DCA. DCA is simple. You invest a fixed amount on a schedule, regardless of what the market is doing. Why does that matter? Because the market's greatest weapon is uncertainty. Uncertainty triggers emotion, and emotion creates bad timing. DCA removes emotion from the decision. When prices are high, you buy fewer shares. When prices are low, you buy more. Not because you're a genius, because your system forces you to act like one. That's not magic, it's mechanical discipline. And over time, it reduces the risk of dumping all your money in right before a drop. But the real power of DCA isn't the math, it's the psychology. DCA is anti-panic because it keeps you moving when you're scared, and fear is exactly when most people freeze, which is why they miss recoveries. Here's the hidden rule. Consistency beats emotional genius. DCA helps you behave like an owner, not a gambler. The boring wins model. 3 rules that protect you. If you remember nothing else, remember this model. These rules will protect you more than any prediction. Rule 1. Boring steps are more reliable than exciting steps. Exciting strategies attract attention. Boring strategies attract results. Rule 2. Systems are stronger than motivation. Motivation collapses during market crashes. A system keeps working even when your feelings don't. Rule 3. Time beats timing. Most people try to time the market. Winners give the market time. That's the whole game. No prediction, no ego flex, no dopamine chasing. Just building a system you can follow for years. The real goal, stop losing before you try to win. Here's the final twist. Most beginners are obsessed with returns, but the first mission isn't returns, it's survival. Because compounding only works if you stay in the game. If you keep jumping in and out, the math can't save you. The biggest investing illusion is thinking you need a perfect strategy. You don't. What you need is a strategy you can stick with even when it feels uncomfortable. Because the market doesn't reward comfort, it rewards endurance. So the boring wins mindset is simple. Broad market, low-fee index exposure, a container you can automate and won't overtrade, DCA to remove emotion and less avoidable drag, fees, panic, constant switching. Let time do what ego can't. And if we say the hidden rule in one sentence, investing isn't about getting rich fast. It's about not getting poor through mistakes. Don't forget that. This is Coin Conspiracy, and we expose hidden rules.